de-risking piece is it seems to be the theme of 25.
Yeah. I mean, too many people got burned with risk that they didn't fully understand when they invested 3-4 years ago and got surprised. So it's much more front and center than before. Yeah.
All right, welcome back to This Week in Carbon. I'm your host, Eddie Smith, alongside co-host Rene Velasquez. And today we have two distinguished guests joining us, Dale Hardcastle and Henning Huenteler from Bain Company, specializing in climate and energy transition, carbon markets. Thank you both for joining us. Really appreciate your time.
Thanks for having us.
Good to be here.
Of course. And I think just to start out and introduce you to our audience, I would love for you to maybe share a bit about yourself and your current role and area of focus and what's brought you into the climate finance world.
Sure, absolutely. So great to be here. And thanks for the invitation. So as you said, Dale Hardcastle, I'm a partner with Bain Company today in Singapore. I kind of lived and worked in sort of Asia around kind of the energy and sort of wider sort of transition sector for the better part of 25 years, having kind of worked across oil and gas, energy, utilities, other things. Today, I've been with Bain for the last 13 years, where I focus primarily on kind of working around kind of the energy transition, or with kind of other sort of investors looking at these sort of spaces in the region as well as globally, including a lot of work within the carbon market and other things which we'll touch on today. Henning?
Yes, thank you, and thanks for the invitation. It's fantastic to be here finally. So Henning Huenteler, I'm a partner with Bain in Amsterdam, focus exclusively on sustainability, climate change, and carbon markets. And this is also everything that I've ever done in my career. I've been with Bain now for 8 years. Before that was a carbon project developer, first in the Clean Development Mechanism, then the gold standards. For in total now almost 20 years. So this is what I do. This is what I'm passionate about, and what I've built a career in, and looking forward to this next hour of conversations.
Yeah. Well, thank you guys so much, and it's going to be a fun conversation. There's lots to unpack. So first thing I want to unpack is the trends that we are seeing. We've seen in 2025, reflecting on this year. It's shaping up to be quite a messy year. And from where you guys sit, I would love to hear your insights on what the biggest shifts are in corporate sustainability or climate action as we enter the start of 2026 in a month, right? What's materially different this year from the past years that you guys have been around in?
Sure. I mean, everyone, I think a great question, and clearly it's been one of those years, right? That has gone in many sort of different directions. I think really to look forward, we need to look back to kind of put things in sort of context, right? If we cast our mind back to January, less than sort of 12 months ago, we were in a pretty pessimistic place, right? The mood was extremely dark. $20 billion had flowed out of sort of ESG funds in the US last year. Banks were quitting climate alliances, and even Larry Fink was saying he was going to stop messaging. He was going to stop mentioning ESG altogether because the term had really been weaponized, right? Something on the order of like only 6% of the S&P sort of 500 was still mentioning ESG in their sort of annual reports by the beginning of this year. And it really seemed like we were moving into a different place where everyone was talking about how sustainability was dead, and then that was really the headline. So what actually happened? If we sort of look at kind of the trajectory of what went down, I think it's really somewhat interesting. While there's no question that many companies have stopped talking about terms and sort of other things, they really haven't backed away from commitments. still, nearly sort of 90% of sort of companies in the S&P sort of 500 still disclose their sort of climate targets. And less than 10% said they were kind of reevaluating their definitions of sustainability and other things. And that's really, the say-do gap that, we talk about, which is, CEOs are doing a lot more to talk about sustainability and value, but they're not talking about it sort of publicly. They're just kind of getting on with the business. So if we go from, where that was going to kind of what's happened over the last 6 months, we, went into Climate Week in sort of New York in September, where it was, clearly a very different vibe. The biggest event sort of ever, with nearly sort of 100,000 participants, 1,000 sort of events, other things. And, a lot of sort of talk about competitiveness and pragmatism and sort of other things, with a real sort of sensitivity to think about, value and focus and sort of other things. So, people just rolling up their sleeves and getting on with it and everything else. And then, of course, last month, then we sort of, went into sort of COP30 and sort of Brazil. And while, depending on sort of where you sit, it was a bit of a mixed bag, with disappointment around the language around fossil fuels and sort of other things. A lot of other things were happening below the radar, right? More money for sort of adaptation finance, more money for tropical forests, sort of other things, and many other sort of elements kind of around that. So, where does this leave us as we sort of, end 25 and look at sort of 26? I think first, the decoupling of kind of action and rhetoric is pretty real. Companies are doing more, saying less, and just sort of getting on with it. I don't think that's hypocrisy. I think that's just reality, and, doing what needs to get done. At the same time, a lot more focus on return on investment and sort of, what levers we can pull and what we can do, which, I think personally to me is healthy, right? In some ways, the events of kind of 12 months ago really just kind of catalyzed, I think, a lot of things that were happening below the surface as companies were looking at targets and thinking about what they could do and where they sort of take it from there. So we started in a very dark place. I think we've ended up in a much more positive one.
Right.
Yeah, maybe from my side to build on that, I fully agree with Dale, and maybe to add a bit more color to that. So I think what we've very clearly seen in the last year is this shift in language around sustainability and the context in which sustainability is mentioned. And maybe kind of an interesting data point that we just recently published is around an analysis that we've done where we've built a really custom AI to assess statements that CEOs of large corporates have made over the last couple of years. And with that system, we analyzed more than 35,000 statements by CEOs. That might have been on earnings calls and podcasts and keynote speeches at conference to understand, do they mention sustainability and in what context, with what flavor. And there were two main findings. The first one, not surprising, which is, yes, there was a clear reduction in the mentioning of sustainability in 2024, 2025 versus some of the data points in the past. And that, I guess, really confirms what many of us in the industry have observed and felt over those years, that sustainability took a bit of a backseat or was a bit deprioritized versus AI, energy security, cost focus, trade disruptions. So not really surprising. What I think is the much more interesting data point that came out of this is that we classified all of those statements into different categories. How are CEOs talking about sustainability? And grouped it into groups around, are they talking about sustainability in the context of business value? Can you use sustainability to actually drive business value in the conventional sense of measuring it? So, top line, bottom line, profitability, these kind of metrics. And then other categories around, is it more driven by a purpose-focused communication? So is it focused around, we need to decarbonize to do what's right or to achieve the greater good? Or do they speak about commitments that they've made publicly? And there's one quite interesting data point is that between 2018 and 2024, which spans the period we analyzed, we see a clear shift from a focus much more on that purpose towards that business value. So, again, can you use sustainability to actually align with the more conventional ways of measuring corporate performance? And specifically as a data point, in 2018, the share of these mentionings in that business-driven sense was around about a third. 34% of all mentionings directly linked it to commercial value. In 2024, that was 54%. So, it's almost a doubling to now more than half of statements directly linking these two kind of concepts. And if you look at the broader spectrum, if you're more on the purist side of the debate, that might be concerning to you, because of course we're moving away from really solving climate change as the bigger goal here. But if you stand more on the, let's say, the realistic side of the spectrum and think through what can we actually achieve with the limited resources that companies have available, because at the end of the day, every company is weighing objectives and then deploying resources against them. You see a much more pragmatic debate of companies that realized over the last 2 years that achieving the commitments they might have made in 2021, 2022, without fully understanding what that means for the company, is actually much harder than they thought. And now they need to rethink where they're spending the resources. They realize change is much harder, which now means let me think through quite specifically, where do I invest my dollars to achieve the biggest bang for the buck? And I think that's, to some extent, a healthy debate, because it now means we're focusing on what we can really achieve in the short term. Which then, of course, leads you to the question, now, where is that? Where do we deploy our money here? And to also build a perspective on that, we then looked at essentially the global marginal abatement cost curve. So building a perspective of what does it cost to take each ton of carbon emissions out of our global economy. And this is on an average basis, by the way. So there's certainly industrial nuance, and some industries have it, harder or easier than others. But on a global level, we then came to the conclusion that around about a quarter of emissions, so out of those 50 gigatons that we emit globally, a quarter of those are already right now, with today's technologies and policies, achievable with a positive ROI, meaning they actually drive corporate financials results just as well as they drive climate results. And so those are really no-brainers. What's holding us back is the distribution of technology, the education of the decision makers to make sure that they actually understand where they can save money if they prioritize their efforts in the right way. So that's almost something that's in the bank that we just need to execute on. There's another third of emissions where we believe between now and 2025, we get that kind of source of emissions into a positive ROI territory. So when we set the right policies, when we deploy technologies and they come down the cost curve, those technologies will get cheaper. They become the logical choice for any decision maker. And so there we see, why not an immediate business case right now, but very clearly a path to making that work. What's then more complicated is the remaining round about 40%, which will be a difficult block of emissions to reduce. And that is something that companies also need to understand and prepare for, and then think through the ways to actually also at some point address these emissions. And of course, carbon markets might play a role here and provide, at least in the transition period, a very interesting tool to drive climate impact, while the actual decarbonization in some of those sectors is still prohibitively expensive or not even technologically possible.
Yeah, extremely well said. And I think, you touched on the business case, right? And this is so important for finance teams and corporates that don't just, want to make climate action seem like a cost, right? But I want to touch on the business case and actually like the risks that, the long-term risks that create a sense of urgency, right, for these companies to mitigate, right? So given the policy rollback that we've seen in the US, and then, the EU is easing their regulations, with China and the Middle East kind of doubling down on industrial policy. I wanted to maybe talk about the long-term policy risks that maybe companies can face if they don't, start to take action in the near term, right? And maybe being that Dale, you're in Singapore, you have that Asia perspective, and Henning, you're in Europe. It'd be great to get your perspectives on this from a regional angle on some of the long-term risks that are significant to, and maybe what your clients are communicating to you guys as well.
Sure, absolutely. And clearly kind of the policy sort of changes have been, pretty pronounced this year. Case in point, if we were to just, look at the US before we look at the other markets, when was the last time you saw such a 180-degree pivot in sort of industrial policy as we've seen, happen there? Which clearly has, thrown many things sort of up and down in terms of, new projects and, called into doubt, hydrogen and sort of all sorts of other things that were sort of already sort of in motion heavily, and sort of recast the focus on sort of other things. I think similarly, I think the direction of sort of, policy change, if we look at sort of Asia, has been a little bit more sort of a slow and steady march. Again, always hard to talk about Asia in sort of isolation because, of course, countries are all very different and have, different sort of points of departure. But one of the things I think we talked about in some of our work this year is, the fact that, even though there's been this kind of reassessment and change, from I think a policy standpoint and where sort of different governments sit, there's a lot of positives here as they sort of think about things. A number of issues have come to the forefront this year as we think about resilience and energy security, economic growth, and sort of other things. And I think a lot of sort of, Asian sort of governments and sort of economies have always been sort of looking about the sustainability sort of shift and then the move to sort of transition across that sort of multifunctional lens, right? How do we sort of kind of develop new green economies and sort of industries to be able to take us forward? How do we sort of capture, as China has sort of, immensely, the energy security benefits that come from sort of building up renewables at scale to sort of help balance out the fuel mix and sort of other things. Yes, it creates sort of new complexities, but once it's in, we no longer have to send sort of cash out the door in terms of for oil and gas and sort of other things. And I think, that sort of slow and steady march has sort of continued, this year, with a strong focus on pragmatism, a strong focus on what can we afford, and how do we sort of weigh the cost benefit kind of across the equation. I think the one other area where, there's also been kind of a good sort of trajectory as we look at sort of Asia is definitely a kind of also, I think, a migration towards more collaboration at more like a regional level or sort of sub-regions, ASEAN, Southeast Asia, North Asia, as well as Southeast Asia, and looking at, building more sort of integrated value chains, looking at sort of innovation, how do we sort of bring these things together? Which of course, pouring the trade issues on the top this year, was just a major sort of accelerant around that. So I think in short, if we look at kind of the Asia story, it's been less about drama, more about sort of a steady march forward. But I think in some ways, the volatility and the turmoil actually, helps the overall sort of direction of travel, and has refocused a little bit, where people are sort of putting money and getting away from things that are maybe subsidies or things that were never going to work anyways.
Yeah.
And from my perspective, I mean, number one, of course, business is one, stability in policy making, right? Like if you create a stable pathway, if you create visibility from a policy perspective, that allows companies to actually take these policies, calculate the impacts, and then make investment decisions, deploy capital against them. And especially what I just mentioned, this middle third of global emissions that we see have a clear pathway to be economically feasible. To achieve those, it's fundamentally important to provide that stability and clarity from a policy perspective, because otherwise we run the risk of kind of making now investment decisions that essentially lock in emissions for a very long time if you look at large industrial facilities. So that stability is critical. I think, well, what we see right now is, of course, more of a volatility. I mean, especially to the point in Europe, there were decisions that maybe went a bit too far in one direction that is now being walked back. I think also important to acknowledge policymakers, are also, going into uncharted territory here, and they try out new things. I would assume they do so with the best intentions, and sometimes they get things right, and sometimes maybe not. But of course, that experimentation, it also creates a bit of uncertainty for companies, and this is something that corporates have to wrap their head around and project that risk whenever they make capital investment decisions.
Yeah. Rene, did you want to jump in here?
Yeah, I just want to. There's really interesting conversation. I was saying to you guys in the preamble, I'm just going to play it kind of quiet and just learn from you guys. Always, it's a masterclass when we speak. Just so curious around two things. So I'll go kind of backwards. I'll start heading with your last take here. I'm just curious around. Can you give me some granularity? Like, are there any particular policy signals, whether domestic or global, that your clients are watching most closely? Because I take your point around businesses thrive with regards to policy clarity because they can actually make decisions over the long term. But to Dale's earlier point, when there's volatility, it's very, very difficult. And then the default is essentially stasis. So can you give us some examples around the policy signals that are helping to drive some of the pragmatism that Dale mentioned earlier?
Yeah, well, I mean, to give an example for where I see things moving in the right direction right now is the work that the EU is doing on carbon removals, with kind of providing very clear signals around the CRCF, the carbon removal and carbon farming initiative that essentially certifies what the EU considers high quality removals. The long-term outlook of linking that into the European emission trading system, providing a clear demand signal for these technologies, but then also all the little policy signals around that with subsidies, for example, through the European Innovation Fund. Just a few days ago, there was a publication around a buyers club for carbon removals that the EU is planning to set up. So all of these are long-term forward demand signals, pricing signals that then companies can plan with and build business cases around it. And to make this very tangible, I'm right now working with a client in the Nordics on a large BECCS project, so bioenergy plus carbon capture and storage, which is a huge capex investment with a lifetime of 20 years. That's exactly kind of that long-term policy signal that we're waiting for. I wish it was already a bit clearer how all these elements are interlocking with each other. But I think directionally we're going in exactly the right pathway to provide more clarity on making these large-scale investments that we need.
Yeah, as a follow-on from that, obviously, I'm not surprised that you mentioned EU, but EU have always taken, or have recently, and also historically taken this leadership position. The US essentially has created a vacuum in terms of policy. I'm just curious in terms of who else is willing to step in and fill that void, if not the EU. It seems that China has been more pragmatic, but not being willing to step in to fill that void. Pragmatism in terms of, they're progressing quite well with regards to their NDCs, but they're not stepping in to take on that leadership mantle. It seems the EU is essentially the guys, or the block that is essentially driving a lot of the policy direction. Do we see action elsewhere? And Dale, maybe that's a cue to coming back to you around what you were saying around the collaboration in the region here within ASEAN. Can you give us some examples around how you're seeing that materialize?
Sure. So, I mean, as always, when we look at policies and sort of situations, a lot of it's very relative and sort of local in terms of where a company sits up with things. I mean, I guess the way I also kind of look at it is, in some ways we've been on a multi-year journey here from the original sort of NDC commitments and other things that were made sort of 5, sort of 7 years ago in terms of the big sort of commitments that everybody wanted to make, which were made by the Prime Minister and sort of other things. And the work of sort of, I think, translating those policies and sort of ideas down to things that actually happen on the ground in a city or a province or a port or sort of other things, is a long, complex sort of multi-year sort of process as we think about all that together. But if we look at where we sort of stand in 2025, I think, some of those things are beginning to come together if we look at discrete things kind of across let's say Southeast Asia, for an example. Clearly, Singapore's at the forefront on so many different things, the carbon tax, sort of other things on the one hand. But also, we can see sort of Indonesia, right, which is this year is sort of making progress on reopening its carbon market. after several years of sort of stepping back to figure out how do we think about the implementation infrastructure around that. Similarly, I think we see workarounds in sort of Vietnam where the kind of government and sort of ministry is being sort of more open to direct power purchase agreements to allow renewables developers and sort of industrial hubs or sort of other things to make direct connections to work around the issues in the grid and the kind of the wider sort of electric ecosystem that need to be done. So I think it's a lot of little things, but as I say, it's like I think positive sort of progress as we look kind of across them.
Yeah, great. And we're definitely going to get into carbon removal, but I just wanted to touch on 2 more segments before we dive deeper into that. And because I think this is extremely relevant for our audience and for the industry as a whole. And this is AI and sustainability, right? I'd imagine this is something that you're seeing and talking about probably every week. And in Bain's recent report, they segment a group of firms, about 20% of the companies that they surveyed, as shapers. And these shapers are deploying 3 times more AI applications for sustainability and capturing nearly twice the value than firms that are not. And the key differentiator seems that it isn't who leads in sustainability, but it's who's leading in AI applications. And leaders that are twice as likely to consider sustainability risks in AI decisions and twice as likely to involve sustainability leaders in AI governance, they're more likely to succeed in these climate and sustainability areas within the firm. So I want to ask you guys, maybe what you're seeing amongst your clients and what that integration actually looks like in practice, right? In 2025. How do you hardwire sustainability into AI procurement and deployment, right? Is this something that you've been working on recently?
Well, maybe we can tackle this, I think, 2 ways, right? I'm surprised it's taken us, 30 minutes to kind of get to this, because obviously it was the conversation of sort of the year, right? I think if there's one conversation that cut across sustainability, whether we were in New York or COP or North, South, East, or West, it was this one, really being, how are we going to sort of, power AI and the increased sort of data center needs? And what does that sort of, mean for emissions, right? With obviously lots of sort of, big numbers thrown around, but really the expectation that in many sort of locales, no matter how we sort of look at it, data center electricity demand is growing much, much faster than our ability to power it. And expectations, I think just, one figure that was commonly talked about, Goldman Sachs projecting that, AI was going to drive, 165% increase in sort of data center power demand by 2030, which I think is in turn, led to kind of all of the one-upsmanship that I think we saw this year around sort of bigger and better. If we think about kind of the biggest, hyperscaler sort of data centers today, they're probably around sort of 500 megawatts in terms of power. What's being built is, 4 or 5 times bigger than that. And then obviously even sort of, bigger numbers that are sort of being looked at. So I think that's created, I think, a lot of sort of, questions around, what to do and everything else. And that leads to, some very, significant, concerns as we think about emissions, right? As you mentioned, we do a lot of work with data centers and investors as well as hyperscalers and sort of others. And our modeling, shows that, between kind of the two, they could emit, about over 800 million sort of metric tons of sort of, CO2 annually by 2035, which if that, were to play out would be about sort of, 2% of global emissions, and about 17% of industrial ones. And if we look at the US, it could be even sort of, much, much higher to, kind of as much as sort of half, right? So just really, I think, sort of, crazy numbers in terms of thinking about that. So, Edward, coming back to your question, as we kind of look at this sort of landscape, how as a company can you be responsible to think about this, right? I think the first thing I would say is, I think many actors in the space today are just racing to get it done. And some of the concerns about really having access to green power and sort of other things and being able to do that have given way to just having secure power, to meet my requirements and sort of do things today. and it's a bit over the horizon as I think about being able to do it in sort of a green way. But I think if we think about kind of both kind of the companies who are sort of, I think, providing the energy as well as those who are sort of consuming it, the more like forward-looking companies are kind of thinking sort of intelligently about how do we think about the requirements in terms of what we're going to need for sort of future demand. Where is that sort of being sourced in terms of our sort of providers, in terms of the emissions intensity and other things? And how do we sort of seek to sort of, strike a balance here as we sort of do all these things? And while there are, I think, some good sort of examples of companies that are doing this well, it's clearly, very early in sort of thinking about many of these sort of considerations, I think, for a lot of corporates. Much more sort of concerned about, how do we get these pilots and make things sort of work within the business as much as sort of emissions. But as you say, companies that are thoughtful think about all this in an integrated way and how to sort of make it work.
Yeah. Thank you for sharing. I think the emissions numbers are staggering, right? And this is something that a lot of people really care about. So it's important to get that right in regard to balancing,
Yeah. And I think that to build, we spoke about, Climate Week and the dialogue. I would say, that was the preeminent sort of, conversation in sort of New York in sort of September it was all about AI, right? And kind of the US power market and power demand. And I think deep, kind of unspoken, but kind of below the surface sort of concerns that, this was going to be a very sort of hot political issue very sort of soon. Just because, we talk about the numbers on a macro sense, but if we kind of look at sort of sub-regional sort of electricity markets and other things, one sees, huge variability and volatility in terms of electricity prices and sort of other things. And of course, data centers are always going to be a much stronger bid, to secure that sort of power than you or I in our home, right? Well, it's obviously much more complicated than I just sort of described. Ultimately, I think those pricing power, drives prices higher and, takes what is kind of an energy issue and makes it potentially a big political one.
Yeah. No, and Rene, I want to get to your point, but it is so true what you're saying. It's what we're seeing in the U.S. We want to get people on the right side to say, we support AI, but when they see their electricity prices rising and maybe water usage going, towards more companies than the areas where they actually live, and also they're seeing AI is going to take jobs away. There's just a lot of fear that's stoked into consumers, especially here in the US, and it's creating this divergence politically. And we're seeing a lot of deals get canceled for big AI data centers in Texas because of this type of problem. But
maybe just to jump in with one more point before I let Henning jump in. I mean, I think also just to kind of give the other side of the story. One thing that definitely sort of comes through when you speak to many of the hyperscalers is, they have actually made huge progress in terms of productivity and efficiency in terms of their data centers and, the energy used per compute, right? I think the problem is that, all of those gains are being dwarfed by just the rapid
absolute compute power
increasing in demand that it gets lost in the fray, right?
Yeah. It's kind of reminding me of like with aviation, right? They start to see increased efficiency with regards to the RTKs, and then all of a sudden they're making or adding more routes, and then they're flying more, and so the efficiency is increasing, but the actual overall emissions profile is also increasing. So just a quick sort of kind of to your report, but also I wanted to highlight something that you said, Dale, which was essentially there's a recent report also by the IEA that came out earlier, which focused on this paradigm shift between energy and AI, and I can't remember when it came out, but I think it was last month. But effectively, it predicted this almost doubling in terms of emissions by 2030. I think the numbers were somewhere like reaching 945 terawatt hours globally is their forecast, but today we're roughly around 415 terawatts globally. And like you said, it's somewhere between that 1.5 to 2% of global electricity consumption. It's increasing significantly. So it's fair to say that AI is just not a marginal demand driver. It's actually threatening to become the primary energy load growth engine, right, across the globe. And certainly, like you said, there's concentration in certain regions. Here in our region in Asia Pacific, there's a lot of significant demand and also therefore growth. But what I think it matters is that not just the emissions piece, which is obviously relevant for our audience, but to Eddie's point, there's other things that are happening, such as grid stress, and you guys named it, right? Dale, you talked about it with regards to, if there's a competition that's inherent within retail, energy users, but also the data centers for the compute power. But there's actually the decarbonization delay that actually is a secondary effect, because there's so much voracious appetite for energy that as we were bending the curve down and facilitating a transition away from fossil fuels, the just overall energy demand is just so great that just we need all energy sources just to power the demand. And so effectively, we're continuously delaying that transition to go away. And it's no surprise then, coming back to COP, that language around fossil fuel phase out is just not tenable within governments, not only from the financial piece, because a lot of them are dependent on those petrodollars, for example, but just they understand the reality of the energy demand for their economies, and they can't afford to take that foot off the gas. So how do you guys see it kind of playing out in the real world? Because you guys are advising corporates around their strategy. How are they navigating it beyond the hyperscalers? Because I think that they're fairly unique in terms of balance sheet strength and having this forward view around trying to meet the forward demand. But how are other industries handling and addressing this kind of A, competition, and then B, the kind of the paradigm shift with regards to AI and energy? Does that make sense? Don't all jump in at once.
Annie, you want to take that?
Well, sure, I can give it a try. Look, I think this is complicated, and it's a field that is playing out as we speak. Nobody has the call it the glass ball that really tells them what the energy supply will look like in 5 to 6 years. I think what of course many are doing, coming back to this ROI of decarbonization, is look at energy efficiency quite aggressively, right? Trying to understand where can they manage their own demand side. And I think interestingly here, while on the supply side, of course, the projected build out of AI is to some extent concerning. On the demand side, I also think there's huge potential, right? I mean, the AI currently what consumes, or data centers in general consume 2-3% of global power output. At the same time, we're losing 6% of global power output just in distribution losses. And then of the remaining roughly 90%, there's huge losses just in inefficiently run equipment and facilities. So I do think that AI will, to some extent, have a positive impact there in helping making grids more efficient. Lots of startups trying to build technologies to use AI to reduce transmission losses and manage the grids much better than before. And then, of course, companies can also use AI and modern technologies, think about Industry 4.0, managing facilities in a way that is much better attuned to both the actual demand output for whatever they're producing, but also the supply curve of power in the grid and manage their demand according to, let's say, power prices to optimize kind of for the stability of the grid. So I think there's a lot of potential. But it's a very dynamic field, and it has to be kind of seen where that exactly will play out and what the exact trajectory will look like.
Yeah, Henning, I think that's a great point, right? Because on the one hand, we read a lot of stories about SMRs and restarting nuclear and all these other sort of potential solutions. But these are distant kind of realities in terms of making this happen versus what we're dealing with in the here and now, right? And other than leaning on more fossil fuels and sort of other things, there are limited sort of cards, other than sort of doing better with what we have and sort of adding renewables and sort of other things at the margin to be able to kind of like make this sort of call. So while obviously we definitely should be sort of investing in these sort of bigger solutions sort of over the 2030 sort of time horizon, we're going to have to be a lot more efficient and do more with what we have in ways that we sort of talked about to meet the call in the short term.
Yeah, 100%. And I think this rolls right into our next segment, which is all about carbon markets and carbon removal, right? And AI can optimize basically everything except for physics. And after all the modeling, companies still hit the same wall, right? They cannot reach net zero without large scale carbon removal. And so I think I want to talk about how the market will actually deliver the removal that we need. And, you know, we'll discuss the landscape and what we're seeing with regards to shifts in corporates mindset. So to start off, you know, for corporate buyers evaluating CDR, how should they prioritize the different dimensions across, you know, building internal capacity and market knowledge, or hedging against price inflation, or you know, trying to, you know, avoid greenwashing cases, right? What are you guys seeing with regards to the mindset of carbon removal markets this past year?
Yeah, happy to make a start here. I think, first of all, this is also kind of a very dynamic and developing field, right? And also just to make clear, removals is a critical path or a critical part of that transition to net zero, but of course avoidance is similarly important, right? I think Rene, you had a fantastic conversation last week with Naomi around different types of climate solutions and the permanence and durability debate, which was fantastic to follow. What I think is often missed with corporates that are looking at removals right now is the supply curve, and how quickly that develops. I think the market itself is ready to scale supply quickly, but in order to do that, what they need again is that stability, right? That clear pathway towards making this financially viable. Otherwise, you know, we're again limited into a bit of a philanthropic and you know, puristic pocket of capital, which is just not going to cut it in the scale that we need it to be. So what's important in my perspective is that companies that have some form of known demand, may that be a compliance demand, may that be a voluntary demand as part of the SBTI commitments or you know, other climate promises and plans that they've set themselves, to start sending demand signals right now, because what we're often seeing is companies that have maybe, let's say, a 2030 interim target that already includes some pocket of removals, to consider this a 2028 or 2029 problem to start thinking about it. But that will, of course, then create the risk of the supply side just not being there, because it takes for many of these technologies,
It's not elastic.
It's too elastic. It takes a long time to develop, to bring to market. And if you wait until 2028, it's not going to be there in the size that you need it. So we ran this kind of analysis together with Allied Offsets to look at what is the demand that we're already seeing within corporate commitments, and came to the result by 2030 that's roughly in the $60 million ton range, which is, you know, it's still small in the broader sense of emissions, but from there on it's going to rise quite significantly. The supply side that we right now see is just not going to deliver that. It's going to deliver roughly 20 million in our estimate. So there's a huge gap, and that gap can only be filled if we start sending these demand signals now, start signing long-term off-takes, working with the suppliers and investors to make it happen, to actually put these projects into the ground.
I mean, that's fascinating, though. So let's just, can I double click on that? I'm just trying to do the maths here, but 20 million tons is what you expect. But you said durable CDR is essentially non-negotiable in the report, if I remember correctly, right? And it said that you estimate removing 10 gigatons per year by 2050 is essential for achieving net zero. So we're talking, what is that? 5,000x scale up? That's
pretty
nuts.
much, yes.
Yeah. Okay. Cool. So then, okay. So can we just break it down?
I mean, just think about the scale. It has to be, in order to make a significant dent to global emissions. I mean, let's take that 10 gigatons by 2050. That is 20% of our current emissions. That is, from a dimension perspective, it is in the similar size as fossil fuel industries right now, that we have to build within the next 25 years.
Okay, and so what are the key demand drivers that'll ultimately deliver that, right? Because you mentioned the targets, the interim targets, long-term targets, and the push towards net zero, but without coming back to what you said earlier around policy direction, these targets are non-binding, essentially. So where's the stick, right? Like, what's going to unlock ultimately this huge infrastructure build?
Look, I think you're putting
asking, right?
Yeah, you're putting the finger exactly where it hurts, which is it's just not there at the moment, right? I think, with this planned link of the COCF into the European emission trading system, the EU is directionally going in that direction. But you're absolutely right. We need that stick, which at the moment doesn't exist, because at the moment all of these procurements are essentially voluntary. Yes.
Yeah. Okay, cool. I mean, something just as a reflection, obviously we had Chris Leeds also on the podcast a few weeks back before COP, and he talked about this very point, that the large FIs, financial institutions, are effective, and large institutional investors that are looking to deploy capital, really large quotients of capital, they don't act in this philanthropic and kind of very vague way. That they need significant sophistication from the infrastructure builders, essentially. They need to understand the discounted cash flows. They need to understand the credit risk and the quality of the offtakes. They need a lot before they can actually start to deploy, let alone debt financing, but even large equity investments to help these types of infrastructure builds actually take place, but that they're very much willing. So can we just call it as it is? Like, let's go back to the AI piece. We talked about hyperscalers. There's Stripe, Microsoft, Shopify, and a handful, Google, and a handful of really large buyers in the durable CDR space. What does it take to actually expand that group to make it greater in terms of participation, right? Like, can we, you guys are advising, and obviously without naming clients, but what does it take for the others to start to emerge and start to structure those offtakes to secure that steady supply and have that price certainty over the long term?
Yeah, I'm going to make a start here, and Dale, please jump in. I mean, it takes a couple of things, right? It takes, number one, it takes the commitment, which at the moment, again, is coming from voluntary commitments from companies that also have the deep pockets. I mean, if you look at the average profitability by industry, you quickly see that these companies are, of course, on the far end of the spectrum, measured by profit per $1 million revenue or so. So they have the financial firepower. The bulk of the emissions globally sits in companies that have a much slimmer profit margin, right? The large commodity players, etc. That at the moment simply can't afford this. Exactly. Yeah. So number one, it takes a broadening of that demand, and to some extent we need policy to step in. Voluntary markets and commitments can make a start, can prove the concept like they did in conventional carbon markets, but eventually this needs to be scaled up by different means. Number two is you need the kind of the education, the infrastructure in the market that allows for a large scale rollout without having large teams that do project by project diligences, that understand methodologies and certification mechanisms in detail, because that at the moment it's just not scalable, right? You have this with the big tech companies, you have this with a couple of professional services companies, but already beyond that, it gets relatively slim. So we need to both strengthen the standards to make it really much more transactional than it right now is, and we need to drive the education on how to do this. And then lastly, you need on the financial side also the more robust financial models and tools to actually then translate that demand and build a structured financial product around it, which might be the equity investment at the beginning. At some point, we very clearly also need debt financing. Just like we've seen in conventional commodity markets, which have just much more maturity on the investor side around these capital deployments.
I mean, I think for all the
reasons.
reasons.
Jump in here, yeah.
Oh, please. I was going to say, I think for all the reasons Henning mentioned, it's going to be a slow path forward, right? Which on the one hand, suggests we need to do all these things and also have some patience, but at the same time, need to also think about avoidance markets as well. because relying on carbon removals alone isn't going to get the job done.
Yeah.
100%. And yeah, I mean, with the dynamics we're seeing with the Science-Based Targets Initiative as well, kind of the turning into compliance in around 2035, right, in the drafts that we're seeing. But specifically, when I was in Singapore last year, I mean, the conversations around the carbon markets are so advanced, and it really seems like Asia is taking a lead in trying to develop deep market infrastructure and really high quality supply. And obviously the Singapore government is playing a big role in that, being one of the only governments with allowing international credits into the carbon tax system. I would love to get your thoughts on, maybe the regional, dynamics that you're seeing in Asia for the carbon markets, because we are seeing quite a lot of voluntary demand coming out of Asia as well, right? Yeah, Dale, if you could touch on that.
Yeah, I mean, before I let Dale comment on with his insider perspective, I think one observation from kind of outside of Singapore is that the ecosystem that you're describing, the expertise that Singapore is building, of course, goes far beyond Singapore itself, right? I mean, the emissions within the country, the scope of the carbon tax is tiny on a global emission scale. The amount of talent, the amount of companies that drive really innovative work there is not aimed at those few million tons, right? It's really establishing a hub that expands then way beyond the country, so the country of Singapore.
Yeah.
I think that says it so succinctly, Henning, which is, I mean, absolutely. Singapore is building the foundation, but I think can be a platform for a lot of other things. Singapore's demand and obviously the standards and the role modeling they're doing is fantastic and clearly is needed. But that only gets us so far. Clearly we need other companies and sort of countries to come to the party. And I would say, we're seeing, brick by brick, things that are building on that sort of foundation as we look at other regional sort of compliance markets and sort of, other sort of segments. But there's still, a huge amount of work to be done to really build that up to where we need it.
Yeah. And on the, closing up here in the final few minutes, I did want to touch on a forward-looking question and looking ahead. What's giving you, let's say, the most optimism about corporate sustainability trajectory as a whole, and what do you foresee for the carbon markets, in the 2030s? Would love to get your forward-looking viewpoints on this as we close out the episode.
Sure. No, I mean, it's obviously December, so good time to be looking forward after we've talked about all this looking back. I mean, I guess the few things that resonate with me. I mean, one is, the countdown has begun. We're sort of, we're now 5 years, from 2030, and that's well within the lifespan of even short CEO, sort of 10 years. So the connection between, what company leaders are sort of doing today and the targets that were sort of set in the past is much more real than it has been for, I think, a long time. So it's not so much an abstract concept, but something that, a lot of sort of, I think, thought is going into what are we going to do, because I may be held accountable for where we sort of end up at the end of the day. To me, that just reinforces some of the things that we've sort of talked about around, it's no longer about ESG, it's really about sustainability and value. And, where can I sort of drive that value creation within the business, the value chain, the situation that I sit? And while, the flavor, may be different in sort of different places, where it could be, more about sort of developing sort of new green products, or is it more about, as Henning spoke about, energy efficiency and sort of other things, or a mix of and combination of them, as well as, of course, thinking about resilience and adaptation and climate risk and physical risk and all the other things that we talk about. But I think what I think is positive and sort of gives hope is that, there is, I think, more honesty and sort of pragmatism about sort of, where we sort of stand today. a recognition that, we're not going to bend the curve against the trajectory that we need to. We need to look for very tangible things that we can sort of do today to both continue to sort of push with sort of, decarbonization, but also prepare for a world that is going to be a lot more volatile. And, pragmatic sort of, I think, honesty kind of around that, which ultimately, brings us back to things that we can do because the ROI is there, or the policies are there, or sort of other things. And I think that's, a much more stable sort of, pathway to sort of bet on, than hoping that, policies alone are going to save us.
Yeah.
Yeah, for me, it's what is giving me hope is essentially this ecosystem coming together. I think if you look at who drove the carbon markets over the last 20 years, and I mean verified carbon markets or project-based carbon markets, it was a mix of idealists, philanthropists, and venture capitalists hoping that some of this will stick. But it was not yet a broad coalition of different capabilities and skill sets. And I think this is slowly but steadily coming together. We have the regulators that are putting into place some of that compliance demand. Singapore, Japan, the EU is now moving in that direction. So that provides really the foundation for growth. We see in the market itself much more robust kind of investment capabilities. We have sovereign wealth funds looking at this with a very long-term perspective. We have increasingly some of the growth equity investors. We have some of the larger investors in the underlying capex, and of course also at least a couple of pilot deals for debt financing of carbon credit projects. And while all of that is not yet really ready to scale, the capabilities are being built, and the carbon market is kind of enriched with these different profiles that will eventually need to build this at scale. And so I fully agree with Dale. This is going to be a long-term journey. The carbon markets are not going to go away, but they're also not going to explode in the next 2-3 years. But bringing all of that together will eventually reach that tipping point where it really transitions into acceleration. And that's exactly the point that I guess everybody of us in the market and the community has been waiting for, it to then really start deploying capital at scale.
No, absolutely. I mean, if one, as a first principle, believes there is going to be a carbon market and there's a future in it, there's little question that there's a pretty big asymmetry today between where prices stand and sort of where a lot of the fundamentals sort of sit, and what it's likely to be in the future. And really, it's a question of, what's your risk appetite and how do you manage that, if you want to capture it.
Yeah. Well, thank you guys so much for sharing. And it was a fantastic conversation today. A big thank you to our guests. And of course, thanks to our audience for tuning in. And until next time. So, yeah.
Thanks for having us.
Great.